Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're going to review velocity banking again, go over the same situation as the last video with more of an emphasis about what is your savings, right? Because people get confused and people get really scared. Like, if have you ever talked to somebody and they're saying things like, "Oh yeah, I should have 3 to 6 months of savings," and then you tell them like, "I don't have any savings," right? Like, there's zero in my savings account, and they freak out like, "What are you doing? You're gonna ruin your life." And I would consider this is just me, the way that I present it. The complete opposite of velocity banking isn't making extra payments directly to a loan or a credit card. It's actually saving money, right? So if you take a look at the Seven Baby Steps by Dave Ramsey, the complete opposite of velocity banking is actually the step one, save $1,000 for your starter emergency fund, right? And I went over this situation in the last video where you're in negative savings, right? You got income of 9,000, expenses of $9,644, and you have negative savings. How in the world are you going to save $1,000? Because you're month one, you're already negative, or month zero, one, whatever terminology you like to use, you're negative now. So how in the world are you going to save $1,000? And if you have a line of credit and you use it like the average American, which is not your main operating account, where your checking account is your main operating account, you're not going to save $1,000. There's no way to do it, right? Now, before we actually get started, I've actually been playing around with AI voice generators, and so I'm going to have my AI wingman kind of present the topic to you all. And I kind of have been playing around with the British voices, so I think it sounds pretty cool. But let me go ahead and play this.
Today we will go over why you don't need to save $1,000 as Dave Ramsey suggests. In fact, you probably won't even need a savings account after this, because your line of credit will be your new savings account.
Thanks, George. You sound so sophisticated. Unlike me, the unsophisticated, what do they call it? Ugly American, right? When they travel abroad and they do stupid things. Anyways, yes. So, again, just as George, the AI voice, explained that we don't need to save $1,000, and he said it in his most sophisticated British accent. Actually, let me just play it one more time again.
Today we will go over why you don't need to save $1,000 as Dave Ramsey suggests. In fact, you probably won't even need a savings account after this, because your line of credit will be your new savings account.
Right, right. That's a good point. So, let's just kind of go over velocity banking with the emphasis on what is our actual savings. So you can see right here, we're in negative savings right now, and there's no way that we can save $1,000. You tell me how, when you're in this situation, you can save $1,000 in Dave Ramsey step one. You can't do it, right? Can't do it. Now, let's say you do have access to a line of credit, and let me go over the first two steps of velocity banking. And what is velocity banking? I didn't even go over that. All velocity banking is a debt payoff strategy using a line of credit as your main operating account. So think about debt and cash flow management. So the thing that we're trying to prevent as we make more money is something called the segregation of income. So if you take a look at this expense breakdown, we have 10 credit cards and a mortgage and some other expenses. So your typical person, they get money in their checking account and they have to pay credit card one, two, and three, loan one, two, and three, put some money in a 401k, put some savings here. And so if your money is split all over the place, how effective is it going to be? It's not going to be as effective. So the whole point of velocity banking is to dump your entire money into one place and maximize this thing that we call cash flow, right? So step one of doing velocity banking is just writing down your budget, and your budget is your attack plan. You don't have to use exact numbers, but you should use on average what you make, right? Like, people get so obsessed, like, does it work if you get paid once a month or twice a week, or bi-weekly? It doesn't matter. Just use an average figure, because here's the thing. I don't know what my average cash flow is, right? This month I got to pay for a new $10,000 roof. But on other months I was like, "Oh my goodness, like I was able to pay off a mortgage under 3 years." So again, even when I was paying off that mortgage under 3 years, I had some negative cash flow months. I did. So my cash flow is unpredictable, but if you use your averages, you know where you're going, right? You have an idea. So the thing is, people get so obsessed about exact numbers, and what I'm going to say is just use some average numbers, right? An average number, so you have an idea where you're going, because nobody can predict how your finances are going to turn out. Just like I was never able to predict, oh, so like 2, 3 months I actually had negative cash flow, and then the next month I had insane positive cash flow, right? And then the next month it's like, you know, good cash flow, and there might be one month that I get negative cash flow again. I don't know, but all I'm saying is that we're going to use averages, okay? So step one is that budget. What's really important is when we do our expenses, we have an expense breakdown, and our expense breakdown is going to list every single debt that we have because again, this is a debt payoff strategy, right? We need to list every single debt that we have, and anything that's not a debt, we just lump into one bucket. Okay? We just lump into one bucket. Now, one of the things that we're going to assume is we make the same income, okay? But unlike Dave Ramsey, right? Dave, where he says, step one, the 7 baby steps works every single time, so there's no exception. He's saying basically saying no exception. And I'm taking a look at this. How am I going to save $1,000? How am I going to save $1,000? Right? And here's the other thing too. Actually, before I get in, oh, did I screw up? Yeah, I kind of screw up. But actually, before I get into this, right? Let me just say this. People think, oh, if I just have a line of credit, I'll be able to know how to get out of debt. But again, if we do it the average American way, we're not going to get out of debt, and we're certainly not going to save $1,000. So let's say we had a car emergency, maybe like a $5,000 car emergency, and we had a $200,000 line of credit. That's probably at least a minimum of $50 payment, right? So if we're in negative $644 of savings, and then we have to add a $50 payment by not using our line of credit as our main operating account, then we're in more negative savings territory. So just having a line of credit is not going to help you. In fact, if you go on Reddit, there are plenty of people out there. I think I've found at least 3 examples of people who have a home equity line of credit and they're struggling, and yet at the same time they have savings, right? And so it's not a coincidence that a person who has a home equity line of credit and has savings at the same time is struggling. It's not. So what we're going to do is going to be the exact opposite of what mainstream personal finance teaches us, which is the step one that we have to save money. We're not going to save money. This is going to be zero. This is going to be same income, and then we're going to have the expenses, right? So the expenses are going to be the same until we do a little bit of re-engineering, rejiggering, or whatever you call it. And so our cash flow right now is still the same as our savings until we make this line of credit as our main operating account, right? And I'm going to actually add one more column than I normally do in this Velocity Bank spreadsheet, which will be our available, and I'm going to put quotes in here, savings, right? So why is it our available savings? Because if we have emergencies, then our line of credit will essentially be our new savings account, right? We have 200,000, and the savings is essentially the available balance minus the available limit, or not the available balance, the current balance minus the available limit. And this is what people don't understand is that when you make your line of credit as your main operating account and you put your entire paycheck in there, you don't need savings, right? Because all of your money is going to be tied to paying off debt. And then again, we're working with averages, right? So on some months, we got to pull out more money than usual. And in some months, we're going to have way less expenses, right? So this is the part I want to emphasize in today's training call or whatever, that you don't need a savings account because your line of credit is a savings account. And if you don't know what a line of credit is, it's essentially um, a financial tool where you can borrow money, pay it back, and use it over and over again. So if you have a credit card, that's a line of credit. But there's other tools that are even cooler where if you can just borrow money, you click a button on the bank's website, goes to your checking account, and you're like, whoa, like this was instantaneous, right? So if you need a quick $5, $10, or $100,000 in cash, well, not $100,000. They have a 10, at least with my line of credit, they have a $10,000 max withdrawal in one day. But if you, let's say you need 10 grand, bam, you click the button on the bank's website or credit union or whatever, and now 10 grand's in your checking account. And they're charging you a certain interest rate to be able to access the credit union or the lender or the bank's funds immediately, right? But so let's go back here. So now even though we're not going to have any savings, right? Again, when you're in this situation, Dave Ramsey's step one is impossible. I don't even know how you save $1,000 when you're negative already. But if we just simply do a debt transfer, right? These 10 credit cards, and I've kind of already done this situation many, many times before, it's $167,000 of debt. So we move this $167,000 of debt into our line of credit. This is just a debt transfer. We haven't paid off the debt yet, and guess what happens just by simply doing the debt transfer? Okay, well, all these payments go to 0, 0, 0, 0, 0, 0, 0, 0, 0, 0. So these 10 credit cards, they go to zero, and we magically went from negative savings, right? Negative savings to $4,701.35 cash flow while not having anything in our savings. Not having anything in our savings. Again, we did not do Dave Ramsey's step one for our quote starter emergency fund because we can't do it. So I guess I proved you wrong, Dave. Doesn't work every single time. In fact, let me get George to say this one more time again.
Today we will go over why you don't need to save $1,000 as Dave Ramsey suggests. In fact, you probably won't even need a savings account after this, because your line of credit will be your new savings account.
Yes, our line of credit will be our new savings account. And what is the actual velocity banking strategy? Again, it's paycheck into the line of credit, right? When we put our entire paycheck into that line, the minimum payment satisfied, and all that money goes into the principal balance, and the interest actually gets lowered because it's calculated by the average daily balance, right? And then as we get our expenses, they're taken out of the line of credit, right? And I've talked about this in other videos, how you actually want to use a combination of both credit cards and your line of credit to handle your expenses, because credit cards have this major advantage that personal home equity lines of credit do not have, which is you have the ability to delay interest by a month, right? Like as you're paying off debt, let's say you have this $167,000 of debt, and then you're paying it off. You don't want to take expenses out of line of credit, because once you take it out directly, then they're charging you interest the day you take it off, or maybe starting from the next day. But when you use credit cards, man, you have this 1 month float period that personal home equity lines of credit don't have. So you want to use the best of both worlds. But I'm not going to go into that right now. But what I'm saying is that we have $167,000 of in a balance in the line of credit, and when we put our entire paycheck in, expenses out, the balance is going to go down by $4,701.35, right? Plus some interest. But when we were here, how would he have gotten out of that jam even if we had that line of credit, right? And the reason why we couldn't get out of jam is because we didn't make our line of credit as our main operating account. That's the special keywords, main operating account, MOA, right? I literally just made up that acronym. Your line of credit, your LOC is your MOA. I don't know if that sounds cool enough to make a shirt off that, but maybe if I get enough hype, I could probably sell it as a T-shirt. Your LOC is your MOA, my main operating account. And then maybe if you click a button on the shirt, I'll get George to the AI voice, British AI voice, to say it. But so let's go ahead and do the calculations, right? So the next month is J2 plus 1, right? And then the next month's balance is the previous month's balance, which is H2, plus the previous month's interest, I2, minus our cash flow, right? And so as you can see here, this cash flow was 4701.35, right? And then the interest is calculated by the average daily balance. So you just click this button right here, find the average to get an estimate of what the average daily balance would be, multiply it by the interest rate, 10%, and then you divide by 12, okay? Now, what is our savings? All our savings is the balance minus the available limit, right? That's all it is. So $200,000, or I could, yeah, $200,000 minus H2. See how easy that was? So 33 grand. And so you'll see that as our balance goes down, our savings goes up, because, right? And you'll see that it grows a lot faster than it would by doing the traditional way of having to save money to pay off debt. What we're doing with velocity banking is with the help of a line of credit. We're going to put our entire paycheck into that line of credit, and then see the balance go down and see our savings go up, right? So I just do copy and paste, and again, So even if we had like a $5,000 or $2,000 emergency, again, this quote savings is there because our line of credit is our new savings account. You see that? So look at all that. And then again, you don't want to like be reckless and say, "Oh, I got 54 grand in my quote available savings, and now I can Airbnb it." No, we these are just for emergencies, and we want to be responsible while using our line of credit, right? So, let's say there's a leak or your roof goes out or whatever, you'll be able to handle it and weather the storm. And then, as you can see right here, in 43 months, right? So let me just do this and this. In 43 months, we pretty much paid off all the debt, and now our savings is $200,000, and whatever's over that, right, would essentially now go into our savings account once we paid off the debt, right? And then, or instead of going into our savings account, it would essentially go back into the line of credit if we do transfer it. Now, I'm not going to go over that today, but what I'm saying is that you have the savings account called the line of credit as you're paying off debt. So let's say you even have a $5,000 emergency on day one. Well, let's just do $5,000. So equals plus $5,000. And then our savings goes down a little bit in this line of credit. And then we scroll down and then we see that this $5,000 emergency just set us back only 1 month, right? Only 1 month. And let me just do 4,000, see if that payoff date is the same. So $4,000 emergency, how does that affect it? All right, well, it still affects it by 1 month. So I'm assuming if I do $3,000, is it still the same payoff date? Yeah. So 3,000 is the magical number where you can still have a $3,000 emergency on day one and still have the same payoff time. But again, you don't want to over abuse this, but this is now your new savings account, right? This line of credit, when you dump all your money into that balance, right, and then take out your expenses out of it, this will be your new savings account, your quote savings account. So I don't know about you, but again, I agree with George, right? Let me play George's voice one more time.
Today we will go over why you don't need to save $1,000 as Dave Ramsey suggests. In fact, you probably won't even need a savings account after this, because your line of credit will be your new savings account.
Thanks, George. You sound so much smarter than this. When Dave says that you should do this no matter what, right? Especially in the British voice, you sound a lot smarter than me. All right. Well, that's it for today. Again, just another emphasis on doing the same scenario over and over again with different highlights. So today's highlight was that you don't need that savings account because your line of credit is that new savings account when you're doing velocity banking.